Australia's most affordable property markets with real long-term growth potential are now in the spotlight as Hotspotting releases its latest Cheapies with Prospects report. For more, I'm joined by Tim Graham from Hotspotting. Good to see you, sir.
Likewise, Aaron. How are you?
Talk to us about the market qualifier. What does it mean when we talk about Cheapies?
Well, Cheapies starts with a median price below sort of $650,000 for most of the suburbs within the local government area. We're finding that investors more and more are just chasing affordability. They still want capital growth, but they need those stronger rental yields as well. So we often call the Cheapies with Prospects the ugly ducklings. They're not always the most appealing in terms of looking at the listing on realestate.com, but the locations that they're built in have really good long-term fundamentals.
What makes a good Cheapie? Is it all about price?
Look, it's pricing. I mean, when we look at the actual property itself, it could be to do with the floor plan. It could be about the fact that it's already got a second bathroom. It could stand out as something that's quite unique in the market. But when we talk about the actual area itself, we want to see really good, the fundamentals that we're looking for, a strong economy. We want to have a lot of infrastructure going into the area, both existing and new infrastructure coming into the area. We love to see job creation. And the real estate metrics that we use to identify when the right time to buy is a rise in sales activity. So if we see low vacancy rates, rising sales activity, it's typically a good sign that it's got a good future ahead of it.
Yes, I see your regional spotlighting on YouTube, the ones you put together, and they're fascinating because they talk about the amount of infrastructure and what's coming next for a lot of these locations. When is the right time to buy a house in a place where there's a huge list of things that are coming, but you want to make sure you don't end up with the bad side? For example, imagine buying in Melbourne CBD when they're putting a tunnel out the front of your house.
Yeah,
how do you kind of choose the right time?
Yeah, it's an interesting one. Well, firstly, I'd say a lot of real estate property investors or even real estate analysts quite often look at real estate data in isolation, and it's always historical. You're looking at it in a rear-view mirror, so it tells you what's happened. But what we tend to do is incorporate real estate data with local economy data, and then infrastructure plays a really big part in that. We say if you follow the infrastructure trail, you'll do quite well. So we like to see lots of money going into areas like education and health. If you can follow the infrastructure trail in terms of hospitals, you do very well.
Interesting, because we see differing reports when it comes to train lines. In New South Wales, there was a big hope that property values next to a new train line would go up, but actually they stayed stagnant. Is that the case when it comes to hospitals and schools, or is it different?
It depends on the actual infrastructure itself. So with hospitals, typically you see a couple of different waves of growth. You see at the announcement stage, you see people start to go, well, great, this is going to be terrific for the area, make it more desirable. So people will start to buy. You'll see a little bit of a rise in growth there. And then once they start to turn dirt, you get your second wave. And then third, of course, is once it's actually completed, because that's when you actually get the big substance in terms of jobs.
Talk to us about affordability and yield and how I guess they combine to create that genuine prospect.
Yeah, it's an interesting one, because the higher we go up in price, typically the quicker rental yields drop away. I remember at the end of last year, 2024, the national market, according to PropTrack and Cotality, was that the national market averaged about 5% in capital growth for the year. But we did an analysis and we found out that about 4,500 markets around Australia actually achieved double-digit growth in that same period. And then about 500 markets had seen over 20% growth. So the reason this is important is if you get rid of all the noise, all those smaller markets around Australia, you can actually see that we've had some incredible growth here in recent years. What does that mean? It means a lot of these markets that have seen such strong growth now no longer have those strong rental yields. So it's getting harder and harder to find. And what we've identified is that there's a real trend to well-located units that are offering really strong rental yields, but also giving you really good opportunities for capital growth as well, which is a new phenomenon in Australian real estate. It's only been really evident for the last couple of years.
We know that real estate is a national treasure. It's the national sport, other than cricket and footy, of course. But given what's happening with the RBA, uncertainties about the economy, are people still looking for genuine investment opportunities at the moment?
Absolutely, and the most recent data that came out about the investors data coming in, investor loans coming in, it has really spiked. So we've seen a resurgence of investors back in the market with a bit of sentiment off the back of a couple of rate drops. And of course, at the same time, we're competing with all these first home buyers that are trying to tap into the 5% home deposit scheme. So you've now got this huge influx of different cohorts all trying to buy the same real estate. So I think 2026 is is going to be a very interesting year.
Yeah, very much so. There's a lot kind of crashing together.
Yeah.
Talk to us about, the standout suburbs. What are some of the key economic drivers that are coming together?
Yeah, so if we start with the cheapies in the city edition, it's been very difficult in that budget that we've talked about to find houses. But as I mentioned, we've been reporting on the fact the trend of units actually outpacing houses on capital growth as well as rental yields for some time now. So we have no concern in recommending units as an investment vehicle now, when in the past it's probably been a little bit unexpected, but people would think if I go to a unit, I'm not going to get that capital growth. Whereas now we've actually started to see it actually outperform houses in a lot of locations.
Why? Why is that?
Well, the first thing is when we say unit, we don't necessarily mean a high-rise apartment. We're not really suggesting that at all. What we're saying is well-located little townhouses and things with low body corp still have a bit of scarcity. The density part's important. So the lower density, we've really started to see markets that have got those types of units really thrive. It's much more affordable. If you look at the unit versus house price, there's such a big disparity, and smart investors have cottoned onto that. They get the better yield, but they're not forgoing capital growth.
It's such an interesting thing, isn't it? You're talking about the past 20 years have been about apartment high-rise growth in the inner cities. We look at what's happening in Melbourne and Sydney and Brisbane, for example. Yeah. But the Victorian Premier, Jacinta Allen, says that Melbourne's going to be the home of townhouses in the future. Yeah. And that will potentially, provide better yiels.
Yeah, they'll certainly provide better yields. As I say, if they're low density, they'll typically have a lower body corp. It's really just your insurances. Yeah. But as I say, in terms of the types of markets that we're seeing the best opportunities for capital growth in that budget of 400 to 600 in the unit space are areas like Canterbury and Bankstown, the city of Melbourne, coming off a very low point, as you can imagine. Even pockets in Brisbane, like the Southern Logan pocket in between Brisbane and the Gold Coast, showing really affordable, low density units that are actually outpacing a lot of the housing markets in terms of capital growth.
Interested in Palmerston, what's unique about that, area as a sole standout?
Yeah, so Palmerston, or the city of Palmerston within Darwin, Darwin's an interesting cat in its own
right. It's been an interesting week.
Well, it's not just an interesting week, it's been an interesting 12 months for Darwin, given that it's come off December 2024, the 12-month growth was actually sitting on 0%, and now it's the nation's leader, which we picked probably 10 months ago now. We said we believe that Darwin will be the...
Why? What's Darwin got?
Look, off the back of very, very poor growth for some time and not much going on, it's now got this enormous infrastructure play that's going in there. It's got a big defence precinct, and we've seen the demand really rush into Darwin. And in fact, that's actually a concern of ours too, that it's such a small market, but we've got all of these investors all piling in. So it's a market you've got to tread carefully on. But for investors that are wanting to spend under $700,000, achieve a house that's giving you a 6% growth, if you've got a little bit of an appetite for a slightly higher risk and a bit more vulnerability, Darwin's your place.
There you go. COVID kind of threw everything when it comes to regional markets as well. Yeah. Went up and then back down again. How are regional markets differentiating themselves?
Yeah, and look, every state's different, but Victoria here is an interesting one. Victoria's suffered off the back of our very poorly managed economy for some time now. So again, last year Melbourne was minus 3% for capital growth, and now we're in the positive territory, just above 4%. And the regions are starting to experience that now as well. We saw for a long time what we call the exodus to affordability. So this is people choosing to leave the capital cities and live in those more lifestyle and affordable markets like your Geelongs, Ballarat, Bendigos, and we're seeing a resurgence of that again. A lot of people thought that was due to the work from home nature that COVID provided, but it is that affordability and lifestyle that people are choosing. And we often see with migration, people come to the capital cities first, and then even part of their visa sometimes have to relocate into the regions. But there's a lot of different cohorts choosing to live in the regions, and it's really that lifestyle play. Geelong, Ballarat both have very strong futures ahead of them in terms of capital growth. You could probably buy a lot of houses in those two markets right now below replacement cost. And
just finally, you talk about infrastruccer. The regions surely don't get as much infrastructure as the cities do.
Well, you say that, but when you've got populations as significant as a 200,000 like your Geelongs or your Toowoomba's of the world, they have to invest in both road, rail, and hospitals to accommodate the people that are choosing to live there. There's a lot of downsizers that have chosen. I've got not enough in super. Maybe I'll sell my house here, buy something in one of those regional places, put a boat in the backyard, and then topping up their super in doing so as well. But they still need that the the health to be able to support their retirement needs, and the road and rail to get them back into the city to see family when they need to.
All right, Tim Graham from Hotspotting, host of the Property Playbook right here on Ticker. Appreciate your time as always.
Pleasure.
Thank you.